Hello, everyone. Welcome to an Options Income Blueprint, Options Income Weekly Live. It's November 7th, 2022 at 11 a.m. Eastern. You're here with Michael Schulman. My name is Emily Norris with Traders Reserve. We are recording this session and we'll be posting it to the member website as well as sending it out to you in your Options Income Weekly newsletter. If you have any questions throughout the session, just pop those in the Q&A box. We'll get to those once we've wrapped up with the presentation. And we meet tomorrow for live trading at 11 a.m. Eastern. With that, I'll let you take it away, Michael.
Thank you. Thank you, everybody, for joining us on Monday morning. Remember, as Emily said, tomorrow is election day, and it's our live session day. Please vote into that PSA, but please vote. I'm going to go over the trades results from last week, a little bit of detail. And this is the most fun part of what I do. I want to drill down, so we might be here a couple of more minutes than many of you who have joined me in the past are used to. I want to talk about Crocs at a little bit of depth, which is a lot of fun. So we were busy, and we were busy because of new positions that were closed or are still open. Devon and Crocs are still open, but we were rolled positions. And when we first designed the update, Emily was the one who weighed in going, it's all income in a week. When we look at positions, you can be myopic and you can say, oh, how is this position? How is that position doing? And with our roll positions and the four core positions, some of these are, you might say, well, I got in at this date and I'm down, compared to what my initial capital was, but you're producing gigantic amounts of cash every week. Look at those rates of return. Now, some of this was because we sold puts expiring in 2 weeks, but some were 1 week. And this is just what you want. And to that point, I don't know how many of you subscribe to the Wall Street Journal, and this article may be outside their firewall. There was an interview with Burton Malkiel, who is 90 years old. And Malkiel said he wrote A Random Walk Down Wall Street and has been a leading proponent for 50 years since the book was published, that you can't beat the market, and he's right, 90% of professional money managers trail the indexes over time. But that 10% number is very instructive because about 7 to 10% of people who have capital in the market, only 7 to 10% are active investors, such as yourself, which means with the proper guidance and the proper discipline and the proper et cetera, and the proper stocks and companies, you can beat Wall Street. This is an example of it. And Crocs is another example that we'll get to in a moment. Our goal every week on a mythical, archetypal $50,000 portfolio is to do 26% annualized return a year. We doubled it. And these are constructs. Some of you may have 500,000, some of you may have 50,000. But this is how we measure ourselves. We don't measure ourselves as a portfolio approach. It's trading, it's cash generation week by week based on annualized rates of return. And if you want to delve into that, it's really not complicated. It's a piece of second grade math. It's all in the training material. So there's the overall performance. It was pretty cool. We did really, really nicely. And there's more volatility in the market because of the Fed, because of uncertainty about earnings season, uncertainty about the economy. And we're grabbing that volatility in the form of premium. So last week, the Fed really didn't surprise anyone. And if they did, I'd like to meet those people. But the market reaction surprised some people. And it went up, it went down, it went up, it went down. And the market still has no idea what to do collectively. There's no collective, rates are going to slow down. There's no collective rate increases going to slow down. The bond market thinks the next rate increase will be 0.5%, and the Fed's language may start getting dovish, but that's only 2/3 of the bond market. Are we going to have a recession? If we have a recession, is it going to be a high unemployment or a low unemployment recession, and so forth and so on? And will a recession hit earnings? And the reason, and I've said this before, is a handful of people who are professionally in the market, and they drive the market, the professionals, have gone through a real bear. And, a crash with the internet, a crash in 07, 08, the pandemic crash, those aren't bear markets. People call them bear markets because it's a sexy headline on CNBC. but that's not a bear. I mean, the bear market that ended in 81 started with the decline of the Nifty 50 a decade before and the beginnings of very high inflation, which started with the Arab oil embargo. And Richard Nixon, literally in those days, the Fed, Arthur Burns, he said, go print some money because I need to hire a bunch of people to make sure I win the election, which he would have won anyway. And so you had huge amounts of government spending compared to the size of the overall market. And we had an inflation-driven bear market for 10 years. And people don't know what to do here, which is an underlying emotional promise foundation of what's going on in the market. And so the confusion is actually good for us. Volatility, if we're nimble and we get in and out of position, like for example, and we'll go over to the last slide, by being nimble and capturing volatility, it means you're able to sell puts that are distinctly further out of the money. To that point, let's take a look at one of my favorite companies and favorite stocks, Crocs. I had a lot of questions about this after we stopped trading it. It's part of two. For those of you brand new, I select our trades, trend in the real world, companies taking most advantage of that trend, which stocks are grossly undervalued or even fairly valued, depending upon whether I think they're tradable. Then you look at the charts. Can we trade them this week, this month, this quarter? What are the chains? Are they liquid? Are they tradable? And what's the premium? Can we get our number? So Crocs is not traded frequently because it only has monthlies, as you'll see in the last line. It's part of what I call the new frugal in our world. New frugal is a trend that says, I'm going to spend more money on certain items. I'm not going to be cheap, but I'm going to spend more money on certain items that I think are going to last or have a very high quality brand, or the brand does something for me. I like the brand. I like being associated with the brand. That's a real part of consumer behavior. In terms of iWorld is the company with the most customization / the most number of products to meet a need wins. So I'll talk about Crocs in a minute, but if you go to Buffalo Wild Wings, start multiplying your choices on the menu, buying them. This kind of salad with this kind of salad dressing, this kind of wing with this kind of sauce, this kind of side, this kind of beer, this kind of dessert. You have 1.4 million last time I looked, it was 1.4 million combinations. You're not going to eat there 1.4 million times. But that approach, and with Crocs, what they have done, which you'll see in a moment, they've gigantically expanded their product line, provide enormous value given the cost of their product. And the brand is winning out compared to cheap knockoffs that you can see at Walmart, a place like that. The stock is grossly undervalued based on the last couple of earnings announcements. It broke out after this earnings announcement. It had a tremendous earnings announcement the previous quarter compared to expectations, but Wall Street didn't know if that was a one-off because it's one, and you'll see in the charts, it was a post-pandemic stock. It was crushed. The chains are quite liquid, but there's monthlies only. And you can see if you take the monthly put and divide it, look at the number of weeks, it's gigantic returns per week. So the earnings came out last week and they just crushed it. You can see the stock was down here. Earnings come out and we go way, way, way up. We go from around, this was about 67 in here. We're up in the 80s. That's the old-fashioned typical blue Crocs. Now, I'm going to stay on this picture for a moment. This is how they started more than 20 years ago. For those of you who might remember him, the late, great Mark Haynes, as CNBC anchor, marvelous anchor, one of the best anchors on television. I saw a picture of him where people were teasing him. I don't remember. He would be suit, tie, blazer, whatever. But when he stood up, he was wearing shorts and orange Crocs. And that's when I started buying. And in those days, they looked like this, and they were orange or blue or whatever. But they were straightforward. Company had some financial issues maybe 20 years ago. And now, take a look. These are the adult Crocs. You can see a couple of kitty Crocs in there in a moment. But this is how the company has evolved, and you can see we're now going back to iWorld and the amount of choices and so forth and so on. So let's extend this and let's take a look at how the company has extended its brand. These are shoe charms. They're quite expensive compared to, I know what you pay for the shoe, and you can stick them on your shoe, and you can see over here. Now, I want to dwell on this for a moment because this is how Crocs came back on my radar. And I was having in and out surgery on my knee, and I noticed that the surgeon was wearing Crocs, or the anesthesiologist, I can't remember. And I said, "You're wearing Crocs?" He goes, "Yeah, I just throw them in the autoclave, well, sterilizing a machine at a hospital." And he goes, "Yeah, it used to be, all sorts of stuff and ruined my shoes, even booties on." And it stuck in my head. Well, during the pandemic, everybody had to sterilize their shoes, not just people in an operating theater in the emergency room. Because of COVID, everybody in the hospital needed to wear sterilized shoes. And there was a shortage of PPE, there was a shortage of booties. So Crocs immediately aggressively started marketing medical product line. And they gave, a member told me in her area that they gave Crocs away at hospitals just to get things going. Now, Figs is a company we have traded. It has terrible investor relations capabilities. They're brand new IPO. And I stopped trading them because their first earnings announcement, or second after going public, was so poorly done. I'm going, these people don't have a clue about Wall Street, which is dangerous. But Figs is the number one and the only singularly focused clothing supplier to the medical profession. And I discovered them, again, like Crocs in the emergency room. I saw someone with a little Figs sign, I don't know, the dentist, I don't know where. And I started inquiring, and they were private, and then they went public. Well, I've always said, for those who've been with me for a while, one day Crocs should probably buy Figs. Well, they're working together now. They have the Figs Crocs pack. Figs is distributing Crocs or linking up, and vice versa. And this is specifically targeted healthcare, but they also target Crocs at other professions. This is the best example. And I'm trying to use examples where you can use your eyes to discover things and send me an email. What do you think of this company? What do you think of this stock? And they also now distribute on Amazon. They have a new boot. They have a boot like this. They have a boot with fleece on the inside. So they're moving and they're extending the brand. It's so important when you're winning. And when you have which we'll look at in a moment, when you have very high gross margins compared to the rest of your industry, it's very important you extend, and man, they are extending. Now, there was a data point that I think Emily provided to me, that pre-pandemic, they were like 35th, and I'm paraphrasing, it might be 32nd, it might be 38th, 35th in terms of teen brands. And by the time the pandemic was over and up to today, they're 6th. So they have a brand that attracts people and keeps people in. So here are the highlights that may be a little difficult for you to read. Big pop in revenue, over 55%. The brand itself of the shoes was increased on a constant currency basis about 20%. They bought a company called Hey Dude, and that was a big pop in revenues. International is very important. I go to Europe once a year. Well, now the pandemic's over, yeah. So I was in Rome in March. I'm going back to Rome in January. I'll probably go to the UK for a conference in the summer. And I, for the first time, noticed Crocs, that and black patent leather combat boots. But use your eyes. So I used my eyes. And here's the big deal. This is the big deal for me. And this is the big deal for investors, not traders. The operating margin was up to 28%, which is really, really high for somebody in their business. And that's not a luxury brand. That this is not a commodity brand, but it's not a luxury brand. This is a big deal. And this is the heart of growth. It gives you more money to market, and it gives you more money to do those brand extensions I was talking about. Earnings per share were gigantic. They were 272 compared to 242. And Wall Street still hasn't taken into its heart, embraced that this could happen for 4 quarters. And it probably won't. But if it did, you're looking at a forward PE of 7 or 8. This is very important. Hey Dude's fine. Hey Dude actually was a little bit of a drag in people's looking at inventory. Inventory jumped. Hey Dude stocked up for 4th quarter and may have also gotten shipments late from China because of COVID lockdowns. But it certainly wasn't enough to dissuade people from jumping on the stock last week. And this is a big deal. Up 65% in Asia. COVID, cool. Japan, Crocs is cool. And what's interesting about Japan, and I lived there for a bit, when there's a fad, the fad sticks. It doesn't go away. So it might not be the hottest thing in the world, but it doesn't disappear as well. So the stock itself cratered after the pandemic, but it has found support. And it's trading at 8.1 times next year's consensus estimates of tape. Think about it. The S&P is trading at, I think, 17. The shoe industry is all over the place because you have Deckers, you have Skechers, you have Nike, but the shoe industry typically evened out over a 3-year period, trades closer to the S&P 500 than it does here. So it's really grossly undervalued, which of course, we're selling puts for the most part. That means you're willing to own the shares. Would you be willing to own an overvalued stock? No. You shouldn't. You should wait. Sometimes there are overvalued stocks that are going to be overvalued for a long time. Microsoft is overvalued for 10 years compared to its peer group. Apple's been undervalued compared to its peer group for 25 years. So you have to take this into consideration in stock specific, but it's grossly undervalued. Here's the 2-year chart. We're at the top of the pandemic and it's trading about 180. Here, the bottom falls out, it's trading around 50. And because Wall Street's reaction after the lockdowns ended was all the pandemic stocks are going away. We're never trading them again. I'm serious. And they forget that there's certain things that change behavior, like Zoom or Crocs. And here you have the 5-day chart after earnings came out. Now, today the stock was overbought, but the stock is down about $4.50 today. And we'll talk about that in a moment. So here you can see these gigantic premiums. These are calls. If you bought the stock at 85 and you sold it at the money, you'd pick up $5 in 2 weeks. And that's about 150% annualized cash rate of return. If you sold the 85 put, a little bit roughly the same. And even though it's not particularly liquid, I look at 300 in the vicinity, and this is sort of in the vicinity. People didn't expect it to run that far. I'm not going to review the trade. The trade is on the website, but one of the things you might look at is look how far out we sold the put. The put that we sold was more than 10% out of the money in a 2-week period. So it actually won 15% out of money in a 2-week period. Right now, we could close it with a hefty profit, but I would still keep the trade on. We may close it later today. We may close it tomorrow, Wednesday. We're certainly going to try to close it early. I just don't want to spend the kind of cash it would take to close it right now. So bottom line, big post-pandemic winner. And it's outperforming in margins, and margins generate growth. Well, you have to have a good product and good management, but margins generate growth. And I failed to mention, in addition to the post-pandemic crash of all the hot stocks from the pandemic, when they bought Hey Dude, the street really didn't like it. They thought it was going to be very dilutive, and that it's a second-tier brand in a certain age group, men's fashion. But Crocs has ubiquitous distribution, and they were able to pump Hey Dude into that distribution network, especially overseas. So it's a good deal. And the premiums and potential rates of return are very high. The other conclusion, those of you who are brand new, never listened to one of these things before or met me in person in Florida or Las Vegas, this is the basis of selling a put. We don't look at charts first and go, oh, wow, this looks good. I look at the real world. Because what if someone assigns us the shares? We have to like the company and the stock. So this is the predicate for everything that we trade, this kind of analysis. So this week, the Fed and most major earnings announcements are behind us. There's a question, will the election matter? And we should focus on cash. Let's go to this point. The election, in my opinion, and I follow politics, but I'm not an expert by any stretch of the imagination. I think if there was a big red tide and the Republicans win the Senate, and right now there's a slight tiny edge in terms of pollsters think that the Democrats will retain 50, which means with the vice president, they still have a majority. If they win the Senate, and they're probably going to win the House, it may boost the market. Because people on Wall Street go, oh, Republicans, more tax cuts, Republicans, no more regulations, Republicans, they'll leave Wall Street alone. That's a wrong set of opinions, but that's what Wall Street thinks. And so the market may be confused. Again, if we have a split Senate, Democrat, Republican House, it's sort of stasis. And in the past, the market is like stasis. They don't want the government to do anything abruptly. And with that kind of a mix, nothing abruptly can really happen. So the market continues to be seriously confused. Let's see what happens in the next couple of 3 weeks. Confusion is volatility. Volatility is premium. And large premiums enable us to sell further out of the money puts and calls. And that's the big deal for us in terms of the high rates of return that you saw at the opening of our session together. So with that, excuse me, let's turn it back to Emily if there are any questions.
Okay, Michael, I know in Options Income Blueprint, we don't do strategies such as leap call spreads, but given your long-term outlook on Crocs, would that be a good strategy for someone who's wanting to do that on their own?
Sure, but I would hedge them. This is such a wildly traded stock after earnings, that's not going to come down. So if you bought a leap, I would also make sure you bought a protected put.
Okay, and just a reminder to everyone, just type your questions directly in the question and answer box as opposed to using the raise hand function so we can see what it is you want to ask. Enrico says, what is the reason that you usually do not wait until Fridays to roll positions?
You get a better deal. The math has changed on rolling in that there's so little time. When we're rolling, there's usually so little time value left in the front week, the position we're buying back, but there's a lot of left in the second week. Time decay may accelerate from Wednesday to Thursday to Friday, but the absolute dollar amounts decline significantly, penny amounts or whatever. So when you just do the math, I've started rolling on Wednesday and Thursday. And this is especially true of the core stocks, General Motors, Pfizer, Marvel, excuse me, and Citigroup. It's also true Bank of America been in position actually longer than I wanted to. And since we're going to be in position for a while, it's a real cash maximization issue. We set out earnings or whatever, but the bottom line is the math makes more sense. And you also, let's say the market goes up and let's say you're selling puts and you do it on a Wednesday for the week from Friday. And let's say that the stock spikes up a bit. You have the opportunity to roll that to a higher strike price within the same period, which we don't often do. The other thing about, let's say you roll on a Wednesday and it's a call, if it goes in the money, it means the amount of time value that you're going to pay for is really diminished. And that means it really is in your favor to buy it back and sell it at a call. So from both a put and a call perspective, the more premium you collect and the earlier you can do it, the math just works out right now because of the way the markets are trading.
All right, Elise notes that Crocs is dropping today. Can you comment on that?
I did, but I'll do it again, which is it's overbought. It's skyrocketed $8 or $9 and it's down 4.5. People are taking profits. It's a technical trading issue. There's absolutely no news. And it's normal. And that's why we sold significantly out of the money put, because you have to anticipate these things. When a stock is rocketing up, especially if it's not a super liquid, big, giant name like Apple, if it's rocketing up, there isn't necessarily foundational support from investors, meaning when Apple goes up, 95, 98, 99% of the people in the stock are investors. When a company like Crocs announces earnings, you have to assume a significant amount of volume of people simply trading the stock. And then if they trade it, they're going to cash in and they're going to leave it and it's going to retrace. And that's what's happening
now. Elise notes, and we still have a $10 cushion. I'm glad you're leading us. The market doesn't know what to do right now.
Thank you. Give that fan a contract, as they say in, well, not Memorial Stadium, Camden Yards. It's a thing that they do in Baltimore when someone catches a fly ball.
All right. Nazreen states, are you using implied volatilities or versus historical volatility in your analysis for picking the proper underlying equity?
Neither. I just went, I'm not going to be rude, but I don't know if you heard what I said. I pick the equity based on what's going on in the real world and the valuation of the stock. That's how the equity is picked. The trade, let me step back. I have a bullpen of 25, 28 stocks that I'm anticipating trading extensively in a quarter or trading opportunistically, one or the other. And I follow probably 4 times that number based on the sectors. You know, I'm overweight in my brain on chips, and overweight in my brain on high margin retail, that kind of thing. And I have special chunks like COVID and climate change and what have you. I don't use implied volatility at all. It's in the old training program. I think we killed it in the new one. I use trading charts, 1 day, 3 day, 5 day, 20 day, to show where support comes in, or where there's a ceiling, one or the other. Those charts, based on the 10-year, 11-year track record of the service, are much more an indicator of the ability to trade short term and not get assigned, or if you're assigned, you can roll very easily. It's the 1, the 3, the 5, really the 3 and the 5 and the 20. And if I'm trading something like a Crocs, which has monthlies, or for whatever reason, I'm trading a stock that I'm going to trade at least 2 trading expiration dates out, which no, then I do look at moving averages. And the other thing I do is I look at, and you can look at this on a screen, there's something called moving average envelopes. It's the poor man's way of looking at volatility. It's the visual way of looking at volatility. Well, let's see if I can call it up. This isn't Schwab's, the old options express is not the best. And let's take a look at something more liquid, but if you look at the chart, okay, so let's get rid of these. First things first. Okay, that's an Apple chart. Let's see. Okay. Oh. There we go. So here you can see they're pretty narrow. These envelopes, actually, this isn't the best charting. Moving average envelope, and maybe I'll do it the next time we do one of these. This would be well, maybe it's because the stock. Let's try another one. This is a dog of a stock. Don't go near it. But let's see if it is a better representation here. If not, next time we do this, I'll call up a different charting program. Nope. It's in the charting. Moving average envelopes are basically 2 lines that will be the above and below the moving average. And that gives you, as I said, it's the lazy or poor man. Lazy would apply to me. The poor man's, poor woman's, poor person's view of volatility is around the moving average. Is this what you can expect in terms of the way the stock would trade based on its relationship to its moving average. Implied volatility in a different market, when this service started, implied volatility was important because, believe it or not, volatility was significantly higher overall. It was 2011. And but it's not, history shows us it's those charts that I alluded to in the moving average envelopes. The other thing is, of course, a major announcement, a product announcement, an FDA approval or disapproval, an earnings announcement by a competitor. They all disrupt the value of using implied volatility unless you're day trading. And we may close in a day, but we're not day traders. We don't use that metric. So I start with the flow that you saw, from looking at the anesthesiologist's shoes to investigating the stock to going to a shopping mall and looking at the line and people at the Crocs outlet mall store, that kind of thing. And that means I don't mind owning the shares if I'm assigned, meaning I think it's a good deal if the valuation is there. So that's how it all starts. And then I look opportunistically where we can trade puts and calls.
Enrico says, I remember that you traded Expedia a long time ago. What are your thoughts on the stock? Are you staying away from the travel industry right now?
No, not at all. Expedia is an open position in the master's program. It's a spread. And we have a net debit, which hopefully will be done in a couple of trades. and I don't duplicate trades between the two. And Expedia also was above the $100 price point. And I don't trade stocks in this service. And now it's below it. Oh, wow. That's something. I'm glad we're out of that position. I like the travel industry. I think it's become a trading vehicle. The four majors, Southwest United, Delta, and American, are traded very heavily. Expedia is traded very heavily, and it's very sensitive. So, however, if you're going to trade Expedia, you have to trade it with silly puts. You got to sell something 10% out of the money. I know earnings were this week. I wonder if they came out this morning. I didn't get an alert. Let's see.
They reported on Friday, Michael.
Oh, they reported on Friday. Excuse me. I didn't get an alert. I guess people didn't like their forecast. And this may also be people because it was a little overbought at the end of the week. It could be technical, or it could be people didn't like their forecast, or one of the things that's happened in travel, since you asked generally about the sector, there used to be something called the shoulder season, which was after Labor Day, September and October. You would call it the shoulder because it was in between the end of summer travel and the Thanksgiving and Christmas holiday travel. And the best evidence of that, 5 years ago, I was in Scandinavia. We're thinking of extending our stay. And the cheapest thing to do was not to redo our ticket. It was simply to buy a one-way ticket because we were in October and they were giving the seats away. That is not true anymore. The shoulder season is extended throughout the fall, partially because of people working from home, working on laptops as I do when I travel, more and more retirees because the early retirement wave during the pandemic and so forth, and people with pent-up demand for travel. So the shoulder season now extends, way out. I know that the airline ticket that I used to go to Rome in March, which I paid $2,200 for, when I looked last time, it was $4,400 and now it's $2,700. But it's still significantly higher than even after lockdowns were over. So the bottom line is I like travel. We're going to trade Delta. We're going to trade United. I like them better. That's certainly better than American. I don't like American's balance sheet. And we may trade Southwest. I don't trade anything other than the four big ones. Now, I'd like to trade Ryanair. It hasn't been liquid enough, but it also pardon the pun, fell off my radar. And I want to get back to it because it did just fine during the pandemic and held up its balance sheets in good shape and so forth and so on. But we're going to trade it. We may trade Expedia back in the service again once that position is closed in Masters and if the stock stays below $100.
Hey, we don't have any other questions at the moment.
Well, I want to thank you all for joining me. I encourage all of you not to be shy and to ask lots of questions, if not today, via email. I answer them all. support@tradersreserve.com. If you're in the master's program, you have my private email box. And I'm always looking for good ideas. So thank you all very much, and I'll see you tomorrow.
Great. Thanks, Michael. Thanks, everyone, for joining us. We have recorded this and we'll be posting it to the member website. We'll also be sending it out to you in your Options Income Weekly newsletter today. And we meet tomorrow for live trading at 11 a.m. Eastern. Thanks and have a good day trading.